I tend to like every founder I meet. You know what I mean? I tend to like, oh yeah, great idea. And you kind of want to cheer them on. You want to lean into it, and so I would find myself that if I didn't have a way to quantify and score, I would tend to like every deal and then later regret going, oh man, why did I rush into that? I started off saying I'm only raising 2 million. On that round, I raised 4. I called in and my secretary said, what is going on? She goes, the facts are she's just going crazy, And so I had the cap at 4, closed it, and then immediately opened it for Goldman's 25 million, right?
Welcome to the Diligent Observer, where we help angel investors see what most miss. I'm your host, Andrew, and every week we explore what works, what doesn't, and why through conversations with experienced startup investors and operators. My guest today is Wade Myers, a decorated Army Ranger turned serial entrepreneur with an MBA from Harvard and 30 years of angel investing experience across over 150 deals. In this episode, we explore the binary scoring methodology that Wade has developed through all this experience with the objective of crushing the cost of diligence, discuss why he thinks the angel ecosystem is still so inefficient, and we get to hear his incredible story of how one angel investment led to a chain reaction that led to a $25 million check from Goldman Sachs. I hope you enjoy learning from Wade as much as I did. Wade, thank you for being with me today.
Absolutely. Great to be here.
So to start out, my classic first question, Wade, what are you excited about right now?
I've always been trying to refine how I think about investing and how I perform diligence and how to crush the cost of diligence, right? Because the challenge of early stage investing is you want to do enough diligence, but usually your check size is so small that there's kind of an issue with, how do you not spend or overspend on diligence, time and effort. So there's kind of I'm always excited about trying to improve that process. But the most exciting investments right now are certainly AI. I mean, there's a lot of exciting stuff going on with AI. And that's a real fun area. And I've got a number of AI investments I'm super excited about.
So I'd love to come back to both of those. First, double click for me. When you say crushing the cost of early stage diligence, that's something that I've spent a lot of brain cycles thinking about. What are some of the strategies or methods that you have been leaning into recently that you feel like are effective?
Yes. Well, and I've been investing for 30 years as an angel and then put together a venture fund 8 years ago and continue to invest as an angel as well as with the fund. It just depends on the fit, right? So for a lot of years and a lot of mistakes, and I'm always thinking back about those mistakes and what went wrong and kind of doing those retrospectives, right? Whenever I do that, I codify all these learnings and then I've been building that into an app and really want to get this to where, the thing is I get so many, like most investors, I get so many pitches per month. I think between me personally, my partners and our venture fund website, we get 20,000 pitches a year. And what's difficult is usually taking the time to sort through that. And I don't want to have a whole analyst pool. Just because someone sends you a pitch deck doesn't mean, we have to review it. So I put in place a whole bunch of gates to quickly but respectfully, help a founder understand. And the first thing is like the startup investor fit analysis, because in most cases, it's just not a fit at all. So I only invest in software. So whether it's B2B, software as a service, or mobile apps or AI, I only invest in software. So if I get medical products or, something, commercial real estate. Now I do invest in commercial real estate, but that's a different deal. I'm here I'm talking about angel investing and venture investing in early stage startups, right? So in most cases, the pitch decks are just coming in either some, robotic AI driven automated spamming. And so I'm trying to quickly filter those out. So we built a, software app that basically walks a founder through a series of questions. And because every investor, whether you're an angel investor or an institutional seed capital investor, every investor tends to have a strategy. These are the kind of businesses I like to invest in. This is the kind of geography, the check size, the stage, et cetera, right? And so those are really easy questions to put right up front. So if someone, comes to me and wants to submit, I want them to use a submission link, which walks through that. So first they ask questions. And after each one of those, if it's obviously not a fit, then they can just get an automatic respectful email saying, I'm sorry, this isn't a fit. And that way, because in many cases, as an entrepreneur, I've raised a lot of venture rounds. And in the early days as a venture-backed entrepreneur, it always frustrated me when I couldn't get a no. So when I was pitching an angel, it's sort of like, hey, I just, a clear no is better. And so I always strive to give someone a clear no, but it's easy. So I go through the fit with my investment strategy. If it's not a fit, it's not a fit. And that weeds out, frankly, over 90%. Because I'm very specific in what I'm looking for. So that's pretty cool, right? So that saves me a lot of cycles and saves the necessity for an analyst effort. So a lot of angels are doing all this themselves, or if you're an angel network, you have maybe some volunteers or students or others that you pay on the staff, right? And so I'm trying to automate all that away. But then when, let's say they hit all those gates and they're a pass and they pass through the gate and it's a go, right? Then I actually want them to continue to fill in information, because here's what I don't want to do. And what I've kind of learned that I don't like. I don't want to try to read somebody's long form bio to try to pull out of that and tease out of that. Are they a good leader? Have they had leadership experience? Are they a subject matter expert in this industry? How long have they been wrestling with this problem? If I just look at someone's LinkedIn profile or read a long form bio, it's kind of hard to pull it out. So I've designed a whole bunch of questions that are all yes, no. Almost all of them are yes, no. So really easy to answer. And it's a binary answer. Either you have done this or you haven't. Then I create a score. And now I use the score to rank the opportunities. So it's way more efficient. So I'll give you an example. So when I look back, a few years ago when I was kind of, putting all the software together to make this process more efficient, I said, okay, I want to learn from all my failures. So I've invested in 140, maybe give or take, founders, right? And so I go, okay, which ones failed and what were the common reasons? Because sometimes that's easier to discern from that than it is the successes, right? And in most cases, the failure was, or I invested in someone that had zero leadership experience, absolutely none, or very little, right? And so suddenly it's really obvious. If someone has never been a leader, if they've never been that person that the buck stops with them, and it doesn't matter, some had been a nonprofit leader, that was better than not, but those that had never led something before. And a military commander's fine. So have you commanded, in the military? Have you led a company, led a nonprofit? Have you led something? P&L responsibility, ultimate authority. And so that one thing was one of the very most important. And how I describe it is this: I would never send someone into battle to lead an infantry company in battle if they had no leadership experience. In fact, I don't want them to send them in the battle if they haven't been to boot camp even, right? But let alone lead, because a startup is high stress, low resource. It's like a battle. And so I'm looking back and I'm going, how would I have expected someone that didn't know how to lead to suddenly become a great leader in this high stress, low resource environment of a startup, right? It seems obvious in retrospect, So I've got a series of questions that just try to ascertain their level of leadership experience. And the same with subject matter expertise. I'm trying to figure out, okay, how long have you been wrestling with this problem you're trying to solve with your startup? Are you a deep expert, right? Another one's just like industry or marketplace expertise. Have you been participating in this industry or marketplace for years? Do you know everybody? Like I built a fintech for an investment banking platform as one of my startups like six years ago. And I had been a FINRA broker-dealer, investment banker. I knew how the process worked. I knew kind of everything about it. Obviously, I was the subject matter expertise, right? But also because I'd worked with a lot of big banks, and knew the banking world, I had a lot of contacts. And so you marry those two things together, and I wasn't asking a single investor, gee, do you know who I should call? Or do you have any ideas? Or can you help me validate my idea? I didn't need validation. I was a subject matter expert. I knew the market needed what I was, wanting to build because I wanted it. And I knew who to contact. And it turned out, so it was a real blessing. Glory to God, right? Sometimes we just get a blessing, but that company was built up and sold in 16 months from closing the seed round, 19 months from launching. It was just a real spot on hit. It was a huge return for investors. But that's just an example of my investors also didn't have any resistance in investing because of the combination of I had a lot of leadership experience, I had a lot of subject matter expertise, and I knew a lot of players in the industry at very high levels with large banks. And we ended up selling that to JP Morgan and working with the global head of digital strategy, global head of investment banking, et cetera. So I just use that as an example, not that I'm a fantastic entrepreneur or anything, but that's an example of what I look for, what I've learned to look for is those kinds of things. And so now that really helps me refine, a founder's pitch, if you will, is I only want to really dig deep on those that are going to score high with leadership experience, score high with subject matter expertise, but also there's tons of these categories. One is business model expertise. Like if someone comes to me and says, I want to build a business to business software app, but they don't know anything about business to business, software as a service business model. They came out of manufacturing and they're trying to build a B2B SaaS app for manufacturing, right? They know manufacturing, but they don't know software. So that's an example of that's a bit of a miss. They don't understand the business model. So there's all kinds of categories like that I'm trying to assess and score. Does that make sense?
So it sounds like you've really, I mean, it's a fascinating explanation because it sounds like you've really just taken stock of, okay, the last 100 plus investments that we've made. Some have been successful, some have not. And you've pulled out these 2 or 3 core themes and then built a screening process that essentially filters for and surfaces the opportunities that most directly correlate with that set of key themes. Why do you think more investors don't do this? Is it lack of experience, lack of reps, lack of, because as you're explaining, this is very systematic, seems very cut and dry. Okay, this is a strong fit. Let's have a call. Or it just seems very simple and obvious. Anything that's simple and obvious, if I've learned anything, is that it was not simple and obvious to arrive at those conclusions. So yeah, just curious, ideate for me. Why do more investors not have such a systematic approach, especially at the angel stage?
Yeah, I don't know. I mean, and why did it take me so long to develop this, right? Because it's only a couple years old. And what I would say is that there's a lot of categories. I kind of dove deep on just 2 or 3. So there's, so I score everything from the market opportunity, and the product or service distinctiveness and maturity, founder culture fit. This is one that's really fun. So think about this, right? Historically, here's what angels do. We like to get involved. We like to get to know the founder. We like to hear the pitch. We kind of want to help. You know what I mean? So there's a desire for most angels to want to meet face to face, to want to hear the pitch and see if there's a connection. But when you're getting so many pitch decks, that's what forced me. And because I've done a lot of business process redesign over the years, right? Like when I was at Boston Consulting Group doing strategy consulting, I did a lot of business process design was a lot of the input into a great strategy, right? That was going to be uniquely better. You typically had to completely redesign a process and completely rethink it. And so I just had a lot of that training and discipline. And so I'm naturally trying to bring that to whatever I do. But there is this friction because angels love that personal connection, kind of want to be, I'll be on the board, I'll help you, right? That feeds a lot of the desire, what an angel wants to achieve from an angel investment. But in my case, I was getting so many pitch decks, and also had a venture fund, right? So it's kind of like, okay, let me throw up some gates here. But one of the things that I was looking for when I'm being pitched by a founder, and I think I have the same problem a lot of angels do. I tend to like every founder I meet. You know what I mean? I tend to like, oh yeah, great idea. And you kind of want to cheer them on. You want to lean into it, and so I would find myself that if I didn't have a way to quantify and score, I would tend to like every deal and then later regret going, oh man, why did I rush into that? I shouldn't have done that. So I kind of forced this quantification and so forth into these objective buckets and scores. But another one that I really like to score is the founder culture fit. So I've talked about founder context fit, right? In terms of the context. Have you ever worked in a startup before? Have you been a leader before? What about the business model? The founder idea fit. Are you subject matter expert to this problem? Do you understand the target customer? How well do you really understand the persona of the target customer? Like the investment banking one for middle market investment banking deals, did I understand the mentality of a middle market business owner and what they went through when they sold their company as I was building a platform? Absolutely. I've owned a whole bunch of businesses. I've acquired a whole bunch of lower middle market and middle market businesses, right? So that's another one is how well do you really understand this customer that you're trying to sell to? Not just the industry, not just the market, but there's this whole founder culture fit, Andrew, which is really fun. What we came up with here is a whole bunch of yes, no questions that would assess kind of your mindset. So for example, I'm going to guess that back in your childhood or in high school, tell me some of the entrepreneurial experiences that you had.
You asking me this question or?
Yes,
Oh
yeah.
yeah, I mean selling candy to your kid, schoolmates, right? That's like the starting point.
Yeah. Yeah. So there's a whole bunch of questions like that, which is, you sold door to door, you had a paper route, anything that said, okay, you always had a side hustle. And so it's not just what you did as a kid, but we have a whole bunch of questions about experiences like that, kind of through childhood, young adulthood, et cetera. So even now, I'm always impressed when someone comes to me and they have like a side hustle. Oh, I got this one e-commerce site. I threw up a landing page. I did this, I did that. You know what I mean? It's like, oh, wow. Yeah, that's pretty cool. Or I put myself through college doing this. And so what I define as founder culture fit is all of these things that would suggest they have an entrepreneurial mindset. And it's like one is a dedication to learning. There's a bunch of questions about how much they read, how much they listen to podcasts, et cetera. Like I'm a voracious reader. I read a ton and just all the time, right? Book summaries, full length books, et cetera. And so one thing that I've seen with really successful founders is they're dedicated to learning. They often have an advanced degree, speak multiple languages, voracious reader, listen to podcasts. They're very intentional about learning. And so that's one of those. So we have several questions that are yes, no. Either you do this or you don't, right? And it's quantified. So we kind of can measure that. And another one is business development acumen. Like, are you a serial entrepreneur? Have you founded other businesses? Have you had a successful exit? A bunch of questions around business acumen, right? Perseverance. We want to assess, have you done hard things? Because running a startup is hard. You can have so many days that you want to just roll over and die, just quit and give up. And so as an investor, I want to know, okay, and you can't just ask them like, how diligent are you? Or tell me about your level of perseverance. And of course, everybody's going to like self-select, oh, I would never give up. However, the questions that we ask, you can't cheat on them. So we came up with a whole list of stuff. For example, were you in the military? That's one level of hard, but then were you in special operations? That's a way another level of hard. Or were you a pilot, like a fighter pilot, right? Or, any kind of specialized, we would go, wow. Another level of hard is, did you attend a military academy? And not just attend, did you graduate from a military academy? That's hard because you're doing like full-time military plus full-time college. And so, did you attend a boarding school or a private, boarding school, private military academy during high school? That's another level of hard compared to just I went to high school. So we're asking specific questions all around perseverance. And one of them is, Were you a collegiate athlete? So if someone's a collegiate athlete at a major university, I know that that means they've been working really hard for at least 10, if not 15 years. That's a whole nother level of hard. And so we just ask really simple questions, yes or no. Did you have a special operations role, or were you a fighter pilot, or et cetera, in the military? Did you attend a military academy? Yes or no? Yeah. Were you a collegiate athlete? Right. And so what we're discerning from these yes, no questions is we're scoring their level of perseverance. Have they signed up and completed something that's really hard, and ideally several things? Now, we could ask 10 questions like that. I think 4 maxes out before you go, oh, yeah, we don't expect everybody to have gone through all those profiles, but we're just looking for enough evidence of perseverance, because that's one of those key traits of being the entrepreneurial mindset. Another one is financial acumen, creativity. Oh, creativity is fun. Have you ever, have you coded a software app? Have you created a work of art? Do you have a patent? There's a whole bunch of things around creativity. If you acted in a, community play, those kinds of things that would just suggest creativity, et cetera. You get the idea.
Wait, do you get a lot of pushback from founders on I know it's yes, no, but still this takes material time investment. And as a founder, right, your time is like the thing. And so there's this sense, at least in the angel world, where it feels like the storyline is that the best or most compelling founders don't have the time or won't make the time to go through a really thorough process like that because they have other options, right? Because they're constantly doing this value exchange of like, is this investment of my time worth it versus the next thing? Do you get a lot of pushback from founders due to the depth of your process, or have you figured out how to keep it pretty tight so that that's not often pushback?
That's a great question. No, it's very tight, and it's way less than a typical application. So a typical angel network has an application form, and it's all these blocky texts. Tell us all about this. Tell us all about that. Tell us all about this. And so a couple of things. It takes a long time to write that, up to 1,000 words, describe your background or describe your bio or describe your experiences as a founder. It's hard to write all that. The other thing, it's hard to read it. I don't want to take the time to read, again, 1,000 a month of blocky text. So we've designed it where it's super fast. I mean, it's really easy. Did you attend a military academy? Yes, no. Did you do this? So there's like, in that culture fit analysis, there's probably 25 questions around founder culture fit. It's just 25 yes, no. It's just click, 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 click. You're done. But what that tells us in the background, we're developing this whole score and this whole profile based on that. So give me a couple bullet points on somebody. Like I bumped into somebody at business school. Okay, get this. Not only was he an Army Ranger, right, which is special operations, but he won the best Ranger competition. I mean, he literally was at the top of the top. And best Ranger, you got Navy SEALs, you got Green Berets, you got Army Rangers. Anybody in special ops comes to that. And he went to Harvard for his MBA, and he was a Baker Scholar, top 5% of the class. And I just remember saying, I want to keep track of you. I want to know, I want to follow your success because the filters that he went through. And then he landed on Wall Street with Goldman Sachs, right? Top investment banking firm. So it's like, oh my goodness. So just those few bullet points tell me so much about that. So to win the best Ranger, well, first of all, you have to have gone through all the military. And he was West Point undergrad, Harvard MBA, right? That tells me more than reading a blocky thing. And I don't want to force you to sit down and fill out a whole application that just takes absolutely forever. To answer the question, it's very quick. I think founders love it because they say, oh, wow, it was really easy. And I actually learned, because they're telling us, I learned how to present my experiences and in a more articulate way.
Wait, I love this because this feels very distinct from, as you said, the typical angel approach, which is, transparently, I think the angel ecosystem as a whole kind of has a bad rap for being this, informal buddy kind of thing. And so there are really thoughtful, intentional, strategic angels that provide huge value and are very thoughtful about, honoring founders' time. Clearly, you're one of these examples. But I love the counter positioning of this strategy as compared to the quote unquote average community. Angel investing as a named thing has really only been around for like 30 years now, mid 90s, kind of band of angels, that time frame. But you've been doing this and benefiting from this for longer than that. And so I'd love to hear, maybe just like walk me through your take on the angel space as you've developed throughout your career. And then maybe as you look forward the next few years, let's say that the whole world adopts, this mindset and the angel ecosystem just like levels up and they get it. What does the next 5 or 10 or 20 look like?
So in general, early stage financing. So if I include angels, early stage venture capital firms, all the way up to growth stage venture capital, in general, this whole early stage investing space is extremely inefficient, extremely inefficient. It's like a needle in a haystack. So there's a million startups per year in the US, and about 3/4 of those attempt to raise capital, and only like, what less than 1% is successful. So, and then you have angels that, like maybe you're a member of an angel network, maybe once a month there's an event and there's 2 or 3 founders that are there pitching. And if you're like me, if you're a software angel, you go, oh, none of them are software. I wasted my time coming. And it's just this, why isn't it more efficient to match up? So over the years, I've seen this industry kind of nascent, kind of rise, but it was always informal. And I've raised a ton of capital for all my startups and pitched a lot of angels. And it's always hard. They're hard to get in touch with. Angels are busy. They're doing something else. This is a side gig for angels. Once in a while, I'll remind a founder of that, and it's like, oh, yeah. I mean, it's hard to get in front of them. It's hard to get a meeting. Yeah, maybe you can pitch to a network. Yes, they kind of flock together, but it's difficult. And so it is a very informal, very inefficient, highly unstructured process. And my attitude as a process guy is this should be much, much easier. So I like crowdfunding sites. I like where, there's kind of a marketplace. And that's what we're building with one of the companies I started in response to this is Proforma, to say, I want a startup to come and build a profile and have a marketplace and have all this diligence and scored and filtered. And so I want to be able to say, this is what I look for. Let me go intentionally look for that. Or someone can, submit based on what I'm looking for and really match make, right? It's like a dating site. It should be simpler. So what online dating did for dating, as opposed to going to a bar, hoping to meet somebody in the old days, we need more of this sort of, angel founder dating process, like a matchmaking. And that's what we're building with Proforma, just to solve that problem. But also what goes with that is the need for diligence. Just like dating sites realize, hey, we need to vet these guys on here, right? We need to make sure there's safety and all that, right? In a similar way, it's like we want to vet founders. Because someone's going to write a check, you kind of typically don't have to vet them too much, right? You're more worried about, in this case, there's always one side of the marketplace that sort of needs vetting. With dating, it's the man. With founders and angels, it's kind of the founder. You just want to get the background. And so how this is maturing, I think, and where it will go, it's just more and more structure like that, to where you'll see more, I think, scoring and filtering and matching to make it more efficient. And I think more angel funds, because, if a typical angel is investing once or twice a year, you kind of want to do at least 10 or 20 angel investments for proper allocation. And maybe you do that within 2 or 3 years. I think a lot of angels, as they write about that 5th or 6th check, kind of go, is there a way to put this in a pool to where it's a little more diversified and I can write just a check once and I have all this admin and get all these K1s and everything, all that. And so I think what we'll see is more structure where, we're combining angels' efforts together into angel funds. We're doing more matchmaking, and it's going to become more institutionalized. And at the same time, I think we've already seen the Trump administration just as already making a move to basically deregulate and make it easier for the common man to invest, where you don't have to be accredited. It's like that joke that says, one of the, easiest ways to create wealth, investing in startups. We've kept the common man away from that. We're trying to protect him. Now, he can go to Vegas and blow all his money, but we're not going to let them invest in startups where the power law would suggest 1 in every 10 is going to be a huge hit. And so all you got to do is invest in 100, you're going to have 10 hits. It should work out with the power law. So I think as we see more structure and more kind of institutionalization of angel investing, we'll also see the bottom of the pyramid open up to where more and more people will be allowed to invest, and more capital will flow into startups. And that structure will be necessary for the less sophisticated investor that the market opens up to. And so that's where I see it going.
What do you think happens to the community elements around this? Because one of the most interesting things to me about the angel investor as a distinct kind of investor profile is motivations are often not profit maximization. Like that is often a motivation, but not the only motivation. And so there are these community elements, the giving back elements. What do you think the angel network of 10 years or 20 years from now looks like?
Yeah, I think there's always going to be an in-person element. There's a number of angel networks I'm involved in where you do enjoy getting together for those gatherings and having a meal and a glass of wine and just talking about stuff, even if the pitches aren't exactly a fit. And, I have a venture studio, which is, I don't know if you know what a venture studio is, but it's kind of a combination of VC fund, incubator, accelerator, founding team. And so we have a bunch of angels that just come in and hang out. So we've told them, okay, first Monday of every month, come in all day and sit through all of the updates of all of our startups in our venture studio and just hang out with us, have lunch with us. And there's this community aspect. They love that. So that's a part of angel investing that you can't automate away or provide too much structure. So I think although you can have like nationwide marketplaces, angels still do like to come together, if nothing else, just for the social aspect. And then they can kind of connect with a founder or two or three and say, hey, I'm willing to help. I'll join your board or your board of advisors. I can make a few introductions, right? There's always that aspect of it because angel investors, I think we always have a heart for wanting to help founders. And so you're right, there's kind of a both, but we see that with a lot of marketplaces where there's a broad marketplace kind of online, but there's also, local events. I just think that even the local events could be much, much more structured. So we're working with a number of angel networks on, hey, use all this process that I've been talking about to filter through, to invite more and more people to apply, make it really simple. And then you can sort of pre-tease your angels. Hey, when you show up on Tuesday, here's who's going to be pitching, here's all their background information, and just really make everything a lot easier, but still don't eliminate the social aspect of it.
What revenue models for these communities get you excited, or what do you think is the right model? The typical quote unquote vanilla angel community right now is built around there's some small fee. It's $1,000 to a few grand, and that gets me access to all of the infrastructure and systems, and I can come to the events and all that, and then I can participate if I like or if I don't. Maybe some have expectations, some are more open-ended. Then you have the sort of syndicate model, and then you've got the fund. Some groups have one, some groups have all three of these. There's some flexibility. I'm curious what you think about as the ideal like revenue model here for kind of the infrastructure providers for this capital allocation to happen.
So if I think of it as an angel investor, I would prefer not to pay like a couple thousand a year and just hope that I might see some deals. I would rather pay a transaction fee for the deals I do invest in and just say, hey, let me look at them all. Let me show up. I'll pay for my meal, et cetera. And then, but if I do invest, let's say I'm putting in 25K, who cares if there's 500K transaction fee? So to me, it'd be like, only charge me when I actually invest. I tend to like that kind of revenue model better as an angel. Now, if I put my founder hat on and say, okay, as a founder, in a similar way, I'd rather not sign up and pay a subscription fee for a platform. Like a lot of the crowdfunding sites charge you a fair amount up front. And then they're going to charge, warrants and so forth. By the time they're done, they're going to take a 10% bite out of your raise. You go, yikes, I'm going to give you $100,000 for $1 million. I would rather, as a founder, have a similar revenue model to say, Well, if I only pay $500 transaction fee, for example, for every angel check, I got 10 checks. I paid $5,000. Who cares? It's a flat fee, right? It's like flat fee realtors, right? Realtors
Mm.
don't need to get 6%. It's like, hey, it's kind of a flat effort for me on something like that. So as a founder, I would like to pay a transaction fee as well. Hey, I'll join your platform. It's all free. I'll fill in my information. I'll try to get matched with a whole bunch of people, and I'm only going to pay for each check a transaction fee. I think that's the cleanest and simplest way for everyone. Now, obviously, an angel network does have expenses, so maybe but a lot of them are, 2 or 3 thousand or more per year. It's like that puts off some angels, and the feedback we've gotten is, hey, pay a lot less. Maybe when you show up, you just pay for that meal or whatever the expense is. But then if you're using some kind of a platform that only charges when you write a check, I think now we're charging only when there's some sort of success.
Mm.
And I would do flat fee, not a percentage, trying to avoid the whole FINRA broker dealer
Oh yeah.
thing, right? So that's what I would recommend.
If you were sitting down with somebody that's excited about the private market opportunity, maybe they just had a liquidity event and they're like, okay, I have some capital to provide. I want to carve out a slice for these private investments. You're brand new. Like I have no idea what it even means to be an angel investor. You've done this a couple of times, both as a founder and investor. Where would you encourage someone like that to start?
Yeah. So the first thing I would do is talk them through an allocation strategy. And because once in a while I'll get a question like, hey, my brother-in-law is doing this thing. I'm thinking about putting in 50K. What do you think? And I go, whoa, 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 whoa. If you're going to be an angel, you got to do at least 10. So if you're thinking about 50K for this one, you should be thinking about another, 450K, about 500. So you got about 500K total you want to put into angel investments, right? And they kind of go, well, no. And what 500K into angel investments would indicate that if you're going to put 10% into private capital, private equity, there's angel, there's venture, there's private equity, there's LBOs. And so if you're putting 500K just into the angel slice, that means you probably have about 5 million you're putting into all the private equity across that landscape and that's only about 10% of your liquid net worth allocation. So that means you have about 50 million you're allocating, 45 million to other stuff, 10% to private equity, and then maybe 10 or 15% of that into early stage angel. And then of that, 10 or 15 or 20% you're going to put into private equity. You want to put that to at least 10 deals. And that's how I go from a 50 grand check to you must be worth 50 million of liquid net worth. And so just that allocation schema helps people understand to go, oh, so I need to be prepared to write 10 of these checks. Yes. So typical angels like 25 or 50K, super angels, 100, 250, but let's take a typical angel. So 10 25s, that's $250,000. But that better not be more than just a few percent of your liquid net worth. So the first thing I do is do allocation strategy. And then I kind of go, okay, now what you want to do is you want to invest in a company where you can add a ton of value immediately through your network, introductions, business savvy, the business model expertise, right? Where you just built and sold a company similar. And on the other side, for founders, I'm always saying, hey, your best angel is one that really understands your market, really understands the problem, understands your customer set, can introduce you to a whole bunch of people because they want to write a check and immediately know that they've dramatically increased the value. And angels like being involved generally. And so that's what makes the most sense. It's really sort of a matchup of bringing in everything that angel knows and everybody they know into that startup they invest in. So then if I'm coaching someone on being a brand new angel investor, it's like seek opportunities where you provide a lot of leverage and you can immediately, add that kind of value. And that really helps them understand, oh, so I shouldn't invest in my brother-in-law's business just because it sounds interesting. No, if you don't know a lot about that, don't do it, right? You have to know enough to do your own diligence and understand it and add value to it. So that's where I'd start with coaching a brand new angel.
And where do I go if I want deal flow, if I want to find opportunities? Like how would you start?
Yes. Well, there are a lot of online resources. There's crowdfunding sites, which are just perfect fine for angels to get started. And there's the angel networks. Every major city in the US, for example, every major city has angel networks. I'm in the Dallas-Fort Worth area. We have probably at least a dozen angel networks. And then there's excuse me, all the incubators and accelerators tend to have demo days. right? So every major metro area has like Techstars, plug and play, accelerator, and about every 3 to 6 months, they're having demo days of founders that they've run through their accelerator program, for example. And so you can easily go to those demo days and see 10, 15 pitches all at once. And then most major metro areas have startup ecosystems that are convening of founders. And it's kind of funny, mostly founders. If an angel shows up, it's like everybody chases the angel around the room. But if you are an
It's a
angel,
dating site,
and
right?
yeah. But if you go to like Startup Grind, for example, like here in Dallas, Fort Worth, I think there's at least 3 or 4 chapters of Startup Grind, where it's a startup community, but it's almost exclusively founders. But man, if an angel shows up there, I mean, oh, wow, it's a target rich environment. So there's, that's what I would tell someone to do is just, look up all those kinds of startup ecosystems from the startup groups to accelerators, incubators, demo days, angel networks, et cetera.
And I think one of the pieces that I'd be curious about is how you would encourage them to start thinking about and developing a thesis that they can then build this systematic methodology around. Because everything, like you said, everybody you meet, you like and you get excited about. I mean, the natural angel inclination is to, wow, this is cool. Like, how can I help you? Maybe this is a great fit for me. Everything looks good the first 6 months. How would you coach someone to put together a thesis and a strategy around filtering?
Yeah, it's almost the filtering for the investor side is very similar to some of the founder filtering, right? So, like a friend of mine just retired. He ran a fairly large defense contracting company, DoD contractor, right? So he's pretty deep on tech, really deep on defense. Knows everybody in defense, right? Knows all the contracting offices, et cetera. I mean, just unbelievably well connected. So someone like him, where he's just kind of getting started as an angel investor, it's kind of simple. It's like, yeah, look for small, defense focused opportunities, startups that are building something. And maybe a lot of it's going to be AI or software that, kind of a new innovations for that industry, because you can help take them to market. You know who to introduce them to, you know how it works. You can provide a lot of that expertise to them. So they might be really good at innovating around AI, for example, but you know how to help translate that into something that's going to be market ready. And so, yeah, it's for the brand new angel investor. It's look at all of your experiences and your network, the industries that you're an expert at, and all the kind of contacts that you have. And the whole idea is then you really want to add all of that on top of the capital, because if you're just writing the check and then there's nothing else to add to it, that's not nearly as effective as it could be.
Love it. Wait, this is fantastic. Okay, we only have a few minutes left. I would be remiss if I didn't ask you for at least one or two stories on how angel investing has been meaningful to you and your story, or lessons learned that you would leave our audience with.
Yeah. So one of my very early startups, I thought was going to be a great idea, right? And I went to my initial angel investor, and said, "Who else do you think should invest?" And so he introduces me to his friend, and then his friend invested, and then I angel invested in another friend's business. This is really interesting. So I'm a brand new founder. I just got started, but I started angel investing immediately. And I was in this kind of startup networking where there's a bunch of us building .coms. This is like 1997, right? That era. And so I wrote several checks, and they all wrote checks in my startup. So we all invested in each other, which is kind of interesting. And then we joined each other's boards. So I go to the very first board meeting of one of my friend's businesses that I put a small check into, and he had this super angel on the board. And I'm sitting right next to him with his board meeting. I go, this guy is great. And he goes, "What are you up to?" And I describe my startup. He goes, "Hey, swing by my office," right? And I swing by his office, and I would describe him as a super angel. It's really funny. I'm kind of pitching him, and then he just pulls out his checkbook and he writes a $100,000 check. He slides it over to me, and he kind of asks more questions. I'm pitching him, and then he reaches over, he grabs the check, he tears it up, he writes another one for 150,000. He goes, "I want to invest even more," right? It's kind of fun. And then he goes, "Okay, I want you to meet a couple of my friends." through him, I had 5 more angels all invest between 100 and 250,000. So this is all like super angel territory. Now I'm well beyond the 20 chasing 25s and 50s, right? And this is a .com day, so it was frothy and all of that. But then one of my friends from business school, he flies out to visit me, wants to know what I'm doing. And I had invested in the deal that he had invested into. So he came out and he says, okay, I want you to come to New York and I want you to come in and do a pitch. So he had a hedge fund. And so I fly out there and I show up and then the room just fills up. I mean, there's like 12, 15 guys crammed around this conference table and they're going, hey, do your pitch. And so I'm kind of pitching. And then one of the guys goes, hey, wait a minute. Have you partnered with, he named this company that I had done a license deal with. And I said, yes. And he goes, oh, and they had just gone public. And he goes, oh, I talked to that CEO. I'm an investor in that company. And he goes, he said he's going to acquire your company. And all of a sudden, everybody else is looking in the room, so my buddy who invited me pulls out his checkbook and he writes a $100,000 check and slides it across the table. And everybody else is going, wait a minute, no one said to bring our checkbook. Wait, what? Stop. Is it tonight only? Right? Do I have to have a check right now? And I'm like, no. And I had some blank subscription forms, and then they're like, don't cut me out. Don't cut me out. And what they heard was this guy who did really well because this company had gone public, had talked to the CEO. He said he's going to buy me. And that's true. We were talking about already acquired me, right? And that entire group, every single one of them invested a minimum of 100. And then I'm thinking it's over, but it's not. So my friend goes, oh, by the way, tomorrow, pop down to Goldman's office. I have a friend I want you to meet. And so then I go down and he goes, go up to the trading floor. And so I go to Goldman and I go up to the floor. The elevator opens and this guy meets me and he goes, wait a minute. Are you that Army Ranger that got such and such company? And I'd never met him. Didn't even know his name. And I go, yeah. And he goes, don't cut me out. Hang on. And then he goes and he gets like 2 or 3 more people. And they grab me in a room and they're all saying, what do you have? Do you have paperwork for us? And then I'm in this room and they start asking me questions. And I'm just kind of talking. And a guy had slipped in. He sits there. I have no idea who he was or what his role was. And when we're done, he goes, hey, I'm so-and-so. I run our brand new venture fund. We went to our private bankers and we raised $1 billion venture fund for .coms. Can I fly out to see you? And so this is, again, all from one friend invited me, and so I go, sure. He flies out the next week. And then he flew back. We did some paperwork and he wired 25 million from Goldman. And it's like, okay, this is nutty, but that's an example of one angel led to another, led to another, led to another. Me doing an angel investment, led to, sitting next to this board member at a board meeting, super angels, et cetera. And so angels flock together. Angels can lead you to other angels. And when you start getting momentum, and when you get a room of angels together and they think there's scarcity, like how much are you raising? I started off saying I'm only raising 2 million. On that round, I raised 4. I called in and my secretary said, what is going on? The fax machine's going crazy. Of course, this is 30 some years ago, right? The old tech, right? She goes, the fax machine's just going crazy, And so I had the cap it at 4, closed it, and then immediately opened it for Goldman's 25 million, right? At a higher valuation. But that's fun. That's a story for you.
So does that still happen in your mind over the next few years? Right now, everything's process and AI, and you got to go through this, workflow. Do we lose some of that? Like, does that story happen to the next founder in 5 years?
Well, so right now it's happening with AI. It's kind of like what I'm seeing going on with AI now. The frothiness is very similar to the .com era, from kind of 98 to 2001, right? It feels very, very similar 25, 26 years later. But not quite as much. That happens mostly in Silicon Valley, not in the outlying pockets, because there's so much sense of following the herd. And if you hear that someone gave them a term sheet, then it kind of, really, really gets it going. But we're talking about angel investing, and to a certain extent, angels don't get caught up in that kind of frothiness as much. In that case, it just happened to be that heady time of the dot-com boom, and getting a bunch of angels in a room. And I didn't ask my friend to. I didn't know he had a checkbook. He literally wrote the check and threw it across the table, and it started this avalanche. And and so it's like, there it is. But I think it's being duplicated somewhat with AI right now.
Well, I'll be interested to see how the next generation experiences angel investing. So, Wade, this has been a pleasure. Thank you so much for making the time to join me today and to share these insights. I look forward very much to our next conversation.
Very good. Thank you.
Thanks for listening to this episode of The Diligent Observer. I'm your host, Andrew, and if you're an angel investor looking for essential angel intel in 5 minutes every week, I think you'd enjoy my newsletter. I send my best stuff, interesting deals, and more straight to your inbox so you never miss a thing. Subscribe today at thediligentobserver.com.